While the S&P 500 is up 25% this year, some of the market's biggest winners from earlier in 2025 just got absolutely crushed. I'm talking about stocks down 30%, 50%, even 70% from their highs. But here's the thing. Some of these beaten down names are setting up for massive rebounds. Today, I'm breaking down 5 stocks that Wall Street got way too pessimistic about. We're talking about real businesses with solid fundamentals that just got caught in the wrong place at the wrong time. Let's dive in. First up, The Trade Desk, ticker TTD. This is the most severely beaten down stock on my list, and if you're looking for explosive recovery potential, this is it. TTD is currently trading around $40. The 52-week high, $141. That's a 70% collapse from the peak. Year-to-date, the stock is down 65%. Think about that. While the market's been partying, TTD shareholders have been in absolute pain. So what happened? The company hit restructuring headwinds, and their AI platform rollout was slower than Wall Street expected. When growth stocks disappoint on timing, the market doesn't forgive. It punishes. But here's where it gets interesting. Management already completed the cost restructuring. Q3 revenue grew 18% year-over-year to $739 million with 43% EBITDA margins. That's not a broken business. That's a profitable, growing company that got oversold. And check this out. Benchmark just upgraded TTD to buy, saying, and I quote, "Prior perceived industry growth hurdles were generally in the rear-view mirror." Translation, the worst is over. The average analyst price target is $63, which implies roughly 50% upside from current levels. But some targets go as high as $98. If sentiment shifts and ad tech recovers, TTD could easily double from here. The risk? This is still an ad-dependent business. If we hit a recession or digital ad spending slows down, TTD will feel it. But at these levels, the risk-reward is starting to look really attractive. Next up, Marvell Technology, ticker MRVL. This one's trading around $86, down from a 52-week high of $127. That's a 33% drop, and year-to-date, the stock is down about 26%. Here's what makes Marvell interesting. The sell-off makes no sense when you look at the numbers. Q3 revenue was $2.01 billion, up 57.6% year-over-year. Think about that, almost 60% revenue growth. They're crushing it, especially in AI infrastructure. Data center revenue is now 74% of their total business, driven by AI and cloud demand. So why did the stock get hammered? Conservative forward guidance. That's it. Wall Street wanted more, and when they didn't get it, they sold first and asked questions later. But here's the bullish signal. The board just authorized a $5 billion stock buyback. That's 7.8% of the company's shares. And we're seeing insider buying from the CEO and COO. When management is putting their own money into the stock, that's a vote of confidence. The high-bandwidth memory market is booming. AI chips need faster memory, and Marvell is right in the middle of that demand cycle. Multiple analysts expect earnings beats in upcoming quarters. At a PE of around 90, Marvell isn't cheap on a traditional valuation basis. But if you believe AI infrastructure build-out is a multi-year trend, and I do, then Marvell is positioned to benefit big time. The consensus price target is around $91, but several analysts see this going back to $120 plus. Now here's a controversial pick, Palantir, ticker PLTR. I know what you're thinking. Wait, isn't Palantir up huge this year? Yes, the stock is up over 150% year-to-date. But here's the thing. It just dropped 15% from its all-time high of $207, now trading around $174. This is what I call a momentum reset. Palantir just reported an absolutely monster quarter. Q3 revenue grew 63% year-over-year to $1.18 billion, 8% above Wall Street estimates. Earnings per share came in at 21 cents versus expectations of 17 cents. They raised full-year guidance again for the 3rd consecutive quarter. Their AI platform, AIP, is driving what CEO Alex Karp called otherworldly growth. U.S. commercial revenue grew 121% year-over-year. The company closed $2.8 billion in total contract value bookings, up 151% from last year. So why did it drop? Valuation fatigue. The stock was trading at over 200 times forward earnings. Even die-hard bulls had to admit it got ahead of itself. Plus, Michael Burry, yes, the big short guy, just disclosed a $9.2 million put position betting against Palantir. That spooked some investors. But here's my take. Palantir's business is accelerating, not slowing down. The pullback from $207 to $174 is healthy profit-taking, not a fundamental breakdown. If you're a momentum trader, this 15% dip could be a golden entry point before the next leg up. The risk is obvious. The valuation is still sky high. If growth slows even a little, this stock could drop another 20 to 30%. But if Palantir keeps converting enterprise customers to their AI platform, this correction will look like a gift in 6 months. All right, number 4, ON Semiconductor, ticker ON. This stock is currently around $47, down from a 52-week high of over $74. That's roughly a 37% collapse from the peak. And year-to-date, ON is down 24%. ON Semiconductor got crushed because of weakening demand. Q2 revenue declined 15% year-over-year. When chip demand slows, Wall Street sells first and asks questions later. But here's the setup. The company is aggressively restructuring and cutting costs, including significant personnel reductions and business exits to improve operational efficiency. That's going to boost margins when demand recovers. And here's the key. ON is a critical supplier for AI infrastructure build-out. They make power management chips and sensors that data centers need. Once the current inventory correction stabilizes, and it will, ON should see demand pick back up. The average analyst consensus price target is around $58, which implies roughly 23% upside. But keep in mind, some high-end targets go up to $70. At a PE ratio that's compressed from where it was 6 months ago, ON is starting to look cheap relative to its future earnings potential. This isn't a sexy AI software play. It's a nuts-and-bolts semiconductor company that Wall Street forgot about. And that's exactly the kind of setup contrarian investors love. The risk? If the chip cycle stays weak longer than expected, ON could stay range-bound. But if you're patient and willing to ride out some volatility, this could be a serious winner in 2026. Last one. Intel, ticker INTC. Now, Intel is a bit different from the others because it's actually up 75% year-to-date. But here's why it's on my list. The stock is still down 18% from its recent peak at $42, now trading around $34. And more importantly, Intel is at a pivotal inflection point for 2025-2026. Let's talk about what's changed. Intel has secured massive strategic capital injections, $8.9 billion from the U.S. government via the CHIPS Act, $5 billion from NVIDIA, and $2 billion from SoftBank. That's over $15 billion in capital that serves as validation that Intel's turnaround plan is real. The company is launching new high-performance AI GPUs for data centers in 2025-2026. If these products can compete with AMD and NVIDIA, Intel could regain serious market share in the AI chip race. That's a massive if, but the upside is enormous if they pull it off. Analyst Patrick Moorhead at More Insights says Intel's turnaround plan is approaching a pivotal inflection point. The next 12 to 18 months will determine whether Intel becomes a major AI player again or remains a legacy chip company. Here's the thing. Intel is high risk, high reward. The company has execution risk, competitive pressure from AMD and NVIDIA, and a long history of missing deadlines. But at current valuations, especially with a low price-to-book ratio, the market isn't fully pricing in success for the new foundry business. If Intel's new AI GPUs deliver even 70% of what they're promising, this stock could rip higher. The risk is obvious. Intel has disappointed investors for years. But if you're willing to take a shot on a potential comeback story, Intel at $34 is way more interesting than it was at $50. There you go. 5 stocks crushed by the market but showing serious recovery potential. TTD, Marvell, Palantir, ON, and Intel all offer different risk-reward profiles depending on your style. Drop your pick in the comments, hit like if this helped, and subscribe for more contrarian stock ideas.